All right. Well, good morning, everyone. Thanks for joining our webinar today. Today, we're going to be focused on funding your business growth. So, revenue versus external financing. My name is Chandler Minaldi, and today our two speakers are James Turner, Fifth Line, and Dave Jones of Altus Alliance. Before I have them introduce themselves, I just want to note, as you have questions throughout this webinar, please put them in the chat and we can try to get to them at the end. James, I'll go ahead and give the floor to you and let you introduce yourself first.
Thank you. So, James Turner, CEO of Fifth Line. We're an advisory firm specializing in raising debt for growth stage companies and offering various financial services to streamline back office financial operations and enhance companies' financial strategies. Primarily serving clients in the $5 to $75 million revenue range. We work with companies across tech-enabled business models, along with consumer goods, manufacturing, and professional services business models.
Great. Thank you. Dave, I'll turn it over to you.
Sure. Dave Jones, I'm co-founder and managing partner at Altus Alliance. We're a revenue growth services firm, and what that means is that we help companies to accelerate top-line revenue growth through best practices in sales and marketing. Been doing this for about 20 years and have worked with over 350 different clients, including some pretty dramatic success stories like DocuSign.
Great. Well, Dave, I'll start with you. Let's talk about some trends that you're currently seeing in sales, and mainly over the past year, what's been your experience?
Sure. Well, I would argue that sales is probably the business discipline that has changed more than any other over the last 10 years. Specifically, once upon a time when you were going out and looking for the Top Gun salesperson, you were looking for the closer, the quintessential closer. And it's not that way anymore because the dynamic of the sales cycle has changed radically. So that now the challenge is not so much closing the deal, the challenge is getting well qualified deals in front of you right up front on the sales cycle. So the importance of SDRs, BDRs, whatever you'd like to refer to them as, the ones that the inside sales, the ones that are finding the qualified leads for you, has become dramatically more important, critical, in fact, as opposed to what it has been in the past. That's certainly one. There's a lot of other changes that we can talk about if you like the tech stacks, and different aspects of building a business and generating leads, that sort of thing. But I'd say that.
I do have a question. How have you seen companies' investment in sales, whether it's hiring, technology, whatever it might be, just resources into sales over the past 12 to 18 months?
Sure. It's driven by something. So this is where the two of us talking about this is synergistic, right? Because typically there's a driver, and that's the need for additional capital. And so the least expensive way of generating capital is sales. However, it's a complicated challenge. That's the challenge of it. But the beauty of it is once you get it set up, it's kind of the gift that keeps on giving. Or you can go out and raise money through debt, through an organization like Fifth Line, or through venture capital or private equity or what have you. So that's the driving force. And then, building a sales organization is it's a significant factor in building a successful company. And it goes in stages from kind of getting the initial deals closed, where you're looking for one kind of a person to hire, to scaling and growing, where you're looking for a different type of sales professional.
Yeah, it's interesting, Dave, because I'm sure James would agree, but really a lot of what our initiatives are aligned to is focused on that top of funnel as opposed to some of the more, strategic sellers and closing towards the bottom of the funnel. So interesting to see that that's a common takeaway, and it's kind of industry agnostic at this point.
Yeah, a lot of the clients that we end up raising money for, it's very rarely they're looking for, chief revenue officers or those closers. It tends to be more feet on the ground, we found a lot of the time.
You bet. One of the big challenges as you're building a company is there's a lot of things that, a CEO or founder knows that they need to do, but the money is not there to do it.
Yeah.
So, proper planning, of course, that's critically important. And we've got a saying that says, "Go slow to go fast," and that is just get it right. Make sure you really understand your targets. Um, who you are pursuing, what the value proposition is, what are the compelling points of product or service differentiation, and all this is critical in terms of building a successful sales organization.
Absolutely. James, kind of in the similar vein, I'm just curious to hear a little bit more about some trends that you were seeing this past year in the finance space.
Yeah, we saw so throughout 24, there was growing popularity in refinancing needs. That was a big one. That was kind of the driver of looking for capital in the first place. What we saw a lot was as we worked with companies, they saw that more capital might be available for them than they had initially planned. It wasn't just a one for one refinancing, it would be refinancing plus. So we definitely saw a lot more companies taking that money and saying, okay, well, what does a funded plan look like? What does an extra two, three, five, $10 million look like on the balance sheet for us to invest in our growth? So we saw that a lot through last year and a lot of the processes we ran. Definitely saw again focus in sales and marketing. That was the first thing we saw cut for a lot of companies in the back half of 22 through 23 was sales, marketing, and new product initiatives. And now those things are coming back around quite a bit. So definitely seeing an uptick in the investment to drive top line.
Um, can I ask, how much are
Sure.
you seeing your clients wanting capital in order to invest in AI initiatives?
So it I don't often hear like that's what we need the capital for. A lot of their product development initiatives incorporate AI in some way. We talked to a lot of companies and they use one AI tool and they call themselves an AI company. But we're definitely seeing a lot more companies integrate AI capabilities in their feature set for their customers. So that would fall just under the general product development. It definitely is I'd say a material part, but I'm still hearing a lot of the investment being in sales and marketing. Now, diving deeper, I would imagine a chunk of that is dedicated toward rather than hiring, 15 SDRs, maybe it's 8 SDRs, and the rest is being invested in some sort of automation and AI capabilities. I haven't got that granular with a lot of companies, but I know, for example, that's a lot of what we're doing ourselves, which is investing in not only just sales and marketing, but everything from client process to management to reporting. A lot of those capabilities are being integrated on our side. So I would imagine a lot of other companies are doing it as well.
We're seeing quite a bit of that because, the question comes up, oh, is AI going to replace all of us? And I think the quick answer is no, it's not. But the people that learn how to use AI the best are going to be the ones that are around tomorrow. The ones that don't
Yeah.
are going to be gone. And so sales is a place specifically in the inside sales portion of the sales organization where AI can be used very effectively in terms of helping to identify the best targets based on the ICP or ideal client profile, and putting together email outreach programs that are well crafted and professional and those sorts of things.
Yeah.
Yeah. I think of it kind of like those who develop good leadership and management skills and those who don't. Those who do end up moving up the ranks at companies and managing teams. Those who don't stay just a small part of the team. So I kind of think of AI the same way. It's like you can basically have an army working underneath you and get the job of 10 people done if you know how to use it properly. Or you can stick with what you're doing and, hopefully you stick around.
Great. Love this dialogue. I think it's all helpful to hear how it's applicable in different spaces and certainly, yeah, exciting to be on the forefront of a lot of this. Dave, a couple other questions I have for you, or at least one to kick off. Just as a company is getting started and trying to get their first couple $1 million in revenue a year, what should they be focusing on? Do you think that that's people, tech, processes? What are some of the most important metrics that you see as it relates to those?
Sure. I mean,
What?
all of that is
Sorry,
important.
I just want to add on to that as well. What do you see as most important? But then, what do you see as the biggest mistakes companies probably make as well?
Okay, fair enough. So all of those are important. And of course, great companies are made of great people. So I think that's number one always. And then the tech stacks that you put together are there to complement, these good people. So focusing on that is important. Um, what does an early stage company need to focus on? I think it's really understanding their market and defining a very clear ICP or ideal customer profile, and then and really sticking to that because a metaphor would be gold miners. You can take the best gold miner in the world and you can send them to Iowa and they're going to come up empty handed, right? But if you take a mediocre one and send them to the foothills of California or up into the Yukon, they could be wildly successful. So taking the time to really dig in and understand what sectors you're going to be focusing on that early stage in order to build your initial beachhead, I think is critically important for companies in that 5 to 75 million dollar or even earlier than that.
hmm Yeah, absolutely. I think in my startup experience, that was definitely a huge miss. And you see it all the way from, some of the closers we were talking about before. Everyone's running in different directions. And if you don't have that unified vision to anchor to, it's impossible to hit the targets that we're promising to investors and the like.
But
I see a lot of companies too. They go after the big fish exclusively and let some of the smaller but highly qualified opportunities go by the wayside. And, while they're chasing that 9, 12, 18-month sales cycle, that could be $1 million contract or a $0 contract if they don't close it, they're passing by a number of these, $100,000, $150,000 contracts that can very quickly pile up over time to, drive good revenue. So I definitely do you see a lot of companies doing that, Dave? They're, not it's not just like we can serve this company well, it's the stage of company that they can fit into.
yeah, that's a great point, James. Uh, as a professional salesperson, there's always the inclination to want to go after the marquee accounts. But I think what is way more important is that you identify accounts within your ICP where you can become a critical portion of their success. And so then when you get a testimonial from them, they're talking about you as if, my gosh, if we didn't have your product or service, we wouldn't be as successful as we are today, as opposed to selling into a marquee account where the product may get put on the shelf and not even installed for months. So
Yeah.
yeah, big adherent to that.
James, once they get to that point, what are some capital options that are available to some of these companies that you've seen? And oftentimes, what are some of the most important metrics for some of these lenders that they'll be speaking to?
As far as once they figure out their ICP and got their sales in order. So it depends on where you're at revenue wise. If you're a SaaS company, for example, once you hit about $1 million or so in ARR, you do have a number of different smaller revenue-based financing options that open up. 3 million, a few more open up. And then once you hit 5 million or close to, you really start to have a number of different term loan or line of credit or other revenue-based financing options still just at scale available to you. What we see is companies tend to use equity at the early stages. Honestly, the more you can bootstrap a business, the better in the long run. Plus, it does make you beholden to an investor in some way who, even if they're an angel, you're still taking someone else's money and they still want to get their money out at some point. Once you take on institutional capital in the form of equity, they tend to have a fund, a life cycle. They need their money out at some point. So you do end up starting to work more on a clock at that point. What we see a lot of companies weigh is, and we always advise companies on this, equity versus debt, bank versus private fund, whatever it might be. Think about what your near and long-term goals are. So we see a lot where companies, and I've had conversations before where, we get paid as, deals get done on the debt side of things with our clients. It wasn't, necessarily in my best business interest to tell this guy that, but I told him, look, take this equity offer because they're a strategic capital partner for you. They'll open up all these accounts. They're not going to do that otherwise. It's a good valuation. They seem like they're going to be pretty hands off. And, they went the equity route. We ended up raising money for them on the debt side about a year and a half later. So sometimes equity does make sense. It just depends on what the overall fit is. Debt can be pretty attractive for a company in the long run. The hurdle you have to get over is that near-term fear you might have of, making that monthly payment on loans at that earlier stage. But I think the whole thing comes down to mitigating risk. Don't over leverage your business. Make sure it's going toward revenue generating opportunities. And there are a lot more options that open up at that point, especially once lenders see you have things, and you asked about metrics like, your sales cycle, how you plan on shortening that or increasing conversion. For SaaS companies in particular, the big one is revenue retention, gross, net. Lenders have a pretty uniform way of looking at it. Companies, I always compare companies tracking revenue retention to snowflakes. Every single one, it seems to be different. So, lenders and equity investors and buyers, they all have a pretty uniform way of looking at it. So make sure you know exactly what it is that capital provider is going to be looking at.
Yeah,
I'd
absolutely.
add one other metric in there is just, yield per rep, I think is really important because kind of harkening back to that question about what mistakes are made. A lot of times a board and leadership may say, okay, we've got the company figured out here. We're whatever, $3 million in revenue. And so let's hire 10 salespeople and we'll be a $10 million company at the end of the year. And it doesn't quite work like that, right? So a judicious way of approaching it is to bring on that first salesperson who may also be carrying the title of VP of sales, doing multiple jobs in any good startup, and then make sure that their yield exceeds the cost of sales before you hire the next person. And then you kind of build organically that way. Then when the second one achieves that metric, then you can add another and add another. And there's a great article from Mark Leslie, who was the founder of Veritas. He built one of those rare CEOs that built the company from 0 to 1.6 billion and then sold it to Symantec for 13.5 billion. So did quite well on that and knows how to build a company. And he wrote an article that's in Harvard Business Review on the sales learning curve. And it speaks to that in a very constructive fashion.
Yeah, I have to check that out. I just made a note. Sounds like it could be an interesting read.
Yeah,
Yeah, and one
absolutely.
thing we can also do is just provide a link to that once this is published, just to have that as a reference for anyone
Sure.
interested.
Sure.
Dave, I'm going to kick it back over to you again. But when you see a company that has successfully raised that next round of capital, whether that be equity, debt, or both, where do you find kind of the best place for them to invest? Is that on the sales side, at least in the sales realm? Is that headcount, software? What does that look like to you?
Sure. Well, in the big picture, it's all stage dependent. So at the very early stages, you're investing in development and product management and then beginning to think about sales. And then you start building the sales force. And then when you finally get to kind of a growth and scaling stage, you're very focused on sales and marketing and spending your money there. And so, then it is a mix. It's just getting good people. It's getting the right people in the right seats on the bus, and then it's getting them the tools that they need in order to be successful. That's another mistake we sometimes see companies make is that they purchase too many tools, and so the sales people and marketing people get overwhelmed with too many tools, and we don't really know what to do with them. So far better to get a couple of key tools that they really leverage and use effectively in helping kind of the sales and marketing initiative at a new company than it is to buy a lot.
Right. And we're even having, it's difficult knowing like the new bright and shiny toy that is on the market and trying to understand the switching costs associated with that whenever you have a formalized process. It's not, these are very clear directives, but in practice, sometimes it can be a little bit difficult to have, unless we're leveraging an advisor like yourself with years of industry experience to help point us in the right direction. But I think in some cases it can be overwhelming.
Yes, absolutely.
James, I'm curious to hear a little bit more about sales revenue and using that as a source of funding. So, what are some ways that businesses can determine what portion of their revenue to reinvest in their growth? I know we talked about that a little bit more, but are there key indicators that founders in the C-suite should be looking out for when evaluating that?
So most of the clients that we deal with are growth stage versus more like legacy businesses or traditional kind of middle market. So they typically invest about 300% of their revenue into growth when they can. So typically what we see is, and I'll use SaaS businesses as an example again, because their cash flow is, a little more specialized. So with SaaS, you sign a $120,000 annual contract, you typically get $120,000 upfront. So, and you recognize that each month over the life of the contract. What that cash allows you to do is you can hire that new sales rep or that new head of marketing or whatever it might be. So what we typically see with companies, and Dave can probably add a little bit more color. I'm sure he gets involved a little bit on the budgeting side of things and for sales and marketing for his clients. But what we typically see is companies use that where they can, and then they figure out, okay, what else? What do I need? I just got renewals this quarter of $3 million of cash. That's great. But I have payroll. I have all these things to make as it is. That leaves me with another, maybe 1.5 million for the sake of argument of investment capital that needs to last me this year. So what do I do with that? So they'll spend that 1.5 million or allocate it budget wise, but they work from the top down on how they meet their goals. And it turns out their plan calls for $3 million in investment this year. Well, they need to find that 1.5 million somewhere else. That typically, it's much more involved, of course, but that typically is a general process we see of how clients determine how much capital that they need to meet their goals. When you're a growth stage business, bottom line is only important in the sense that are you going to burn so much that you turn off investment opportunities for you? And are you, generally sticking within the rule of 40 for SaaS businesses, growth plus your burn. So we generally find companies are really focused on how do they meet their top line goals and their major initiatives for their product, for their market, whatever it might be. They use whatever revenue they can in the meantime to fund that. And then whatever gap is covered is taken care of by some type of additional financing. Otherwise, what happens is companies choose, okay, we're going to roll back some of our initiatives, extend out some hiring, which, from an overall perspective is, can be a very responsible way to run a business. The only downside is you may miss some windows on your product market fit, or you might just be a little bit behind, by a quarter or two in things like revenue.
Right.
I guess something I might add to that is just, going out and finding additional capital during that early stage is critical. And there's different types of companies. There are companies that are just super fast, hyper growth. Those are exactly the ones that venture capital are looking for. And so when you sign up for that, there's a lot of pressure on significant growth, and of course, sales is the one that has to deliver on that. So you need to invest in that space. But even if you're not going that path, um, demonstrable successful revenue generation through a successful sales and marketing initiatives is critical to being able to successfully do fundraising. So I imagine, when you're going in for the debt,
Yeah.
you're taking a really good look at that to make sure that they've got an organization that can yield enough to pay back, make their monthly payments. Private equity is the same way, ventures the same way too, but just in a different light. So And again, sales is the least expensive form of capital, once you kind of get it rolling. So constantly investing in that, um, and a stepwise approach is critical to ultimate success.
Yeah, one of the things that we always run, not always, we run into frequently with clients is, I definitely see it's a combination a bit of the finance side and the sales side, but being able to effectively forecast sales. There's always going to be anomalies. There are going to be things outside of your control, but we see a lot of companies, they forecast, the next 12, this quarter is going to be 5 million in sales. It's like, that's great. And then you get 30 days into it and they've only achieved $500,000 in sales. It's like, well, it's going to be heavily weighted back into the quarter. And you get midway through the quarter, they're debt, and you just know that they're not going to hit their plan. So we definitely see that quite a bit. I don't know if it's a process challenge, or I know salespeople are always optimistic, but that's definitely something we see that companies, we always advise companies to be more, don't be too conservative because you still want to have goals to reach, but make sure your targets are realistic, because there's nothing, my opinion, more demoralizing than every month or every quarter saying, yep, we misplan again, we misplan again, we misplan again. It doesn't really help boost morale.
Absolutely. Forecasting is always a real challenge. But it's one thing when you're a $20 million company and you've got a good history to look in the rearview mirror on and figure out like what is realistic.
Yeah.
It's a very, very different thing when you're a $1 million company and you have no rear view mirror, and you're trying to figure out, okay, what's realistic growth? So I subscribe to, during those early years, you want to be as aggressive as you can, but in the same light, like you're saying, you want to make sure that the sales team has goals that they can achieve and that they do achieve until you kind of get a good runway, where you can look back and then figure out what indeed is the definition of reasonable growth, or aggressive growth, or whatever you want it to be.
Yeah, I was telling Chandler during some of our annual planning this year, I'm like, you're never probably going to hit the monthly targets. You'll likely hit, quarterly targets. On a 6-month basis, you'll have a very small margin of error, most likely, and even lower on annual. But yeah, forecasting is impossible. It's always, it can come down to, oh, the guy needs to sign off on this is a last minute vacation. It's going to be 2 weeks till he's back. It's like, okay, well, that throws off my entire quarter now as a result. So yeah, definitely it isn't. Definitely an art, a science, and a little bit of luck on the forecasting side of things.
Right, right.
Absolutely. And James just showing a peek behind the curtain that it'll be a demoralizing activity for me to forecast on the side of things. But as we're nearing the end, let's look ahead. So, Dave, what's exciting to you about 2025, and what are you looking forward to working on this year?
Well, I think AI has all sorts of potential, and everybody's looking at it. And is it one of the? Are we looking at another, PC, or here's the internet, or here's cell phone, or something like that? That's going to be just a watershed event. And boy, the scale of investment that you see in that space right now says yes, it's going to be. Or is it going to be a bust? Like, whatever, pen-based computing, or something that there was a lot of hype around, but just never really materialized. And I think there's strong arguments both ways. The biggest challenge is going to be, AI today is kind of a classic technology looking for application. And there's a lot of places in sales where it can be applied to really good use. Um, but it's going to have to be more than helping students write their term papers, or helping SDRs write effective email outreach programs. That's good, but that's not a killer app. That's not an enterprise app. So watching that crystallize and find its real place in the real world, I think is going to be exciting.
Definitely. James, what about you?
I'd say just general market wise, clients seem to be much more interested and active in looking at different financing options, which is obviously good for us. I'm hearing more for companies that are about ready to actively engage in some sort of sale process, but they know it's going to take 12 to 18 months because there's preview, feedback, changes, improvements, and then, revisiting with the buyer. So that is something that's different than we saw going into last year. It was a lot of in the next 6 months, they expect that to happen. And now we're hearing that it's actually happening. So I think that'll be good. Back half of the year, you'll really start seeing more IPOs, larger M&A, which does trickle down to our market on the growth stage side of things because investors start seeing that liquidity come back. They get more comfortable. They put more money into businesses so they can do things like hire Dave. And what they'll do is be able to invest in sales, marketing, technology. For us personally, you mentioned the AI aspect of everything that's going on, Dave. Chandler obviously knows this. We've been working on a ton of stuff for both client-facing work, client reporting, improving our deliverables to them on an ongoing basis, or in the debt advisory side of things. And in our internal operations, we're streamlining a lot on that front as well, and even working on a couple of lender-focused applications to help with their underwriting, hopefully to start piloting this year. So I think AI as a whole does have a lot of capabilities that will help. I really can't see any industry that can't benefit from it. My big thought is, and Dave, I'm interested in your take on this too, is we're taking a very methodical step-by-step approach, not trying to do too much at once, where I know some of these companies try to throw everything automated, but we're trying to take a more, let's solve this one little problem here, and then let's solve the next problem and the next problem, hoping that, the goal is it compounds more over time. But yeah, no, I'm excited about this year.
I think that's a good way to approach it, very judiciously, because artificial intelligence is not what everybody thinks it is, right? AI in its current manifestation, it doesn't think, right?
Yeah.
These are large language models that have got a ton of data that they can go back and look for patterns and answer questions and that sort of thing, but they don't think. And that is true artificial intelligence. So, that's a natural intelligence, and we're not there yet. And so, I personally think that the investments and valuations in some of these companies are beyond ridiculous. And I think that
Everyone forgets what happened 4 years ago with the metaverse and Web3.
Right, right. Well, and I'm old enough to remember back to 2000 when the tech bubble burst.
Yeah.
And so valuations were just going through the roof. And the logic back then was wow, well, what does America do best? It's innovation and technology and stuff. So is there any reason for that to fade away? And it's well, no, well, keep on investing,
Yeah.
and the valuations just went crazy as they are today. And just seeing DeepSeek come out from China this last week,
Yeah.
and what that did to the valuation of NVIDIA, I don't have the number off the top of my head, but it was literally valuation
It went down
dropped
I think it bottomed out 21% down for the day, and then the next day it bounced right back up.
And nobody even really knows if DeepSeek is real.
Yeah.
Right? So it's just wow, when things are that volatile and moving that much on emotion, I say beware, right? Because it's nice having happy, healthy, growing markets, but it's not so great when it gets out of control, because there will be a correction.
One thing, and Chandler, do we have time for one more question for Dave? Okay.
Yeah, and
so
then
I am
we'll
curious,
probably
Dave.
wrap up after that.
Okay. We've been, like I said, we're looking at AI tools and techniques internally to streamline a lot of things. One thing that, we've talked about a bunch, but never pulled the trigger on because we haven't really loved the options, is a lot of sales oriented items. There's one thing behind the scenes on processing stuff, but a lot of companies try to use AI for prospecting. They think it'll, streamline a lot there. Any test case we've ever looked at and tried ourselves was below disappointing. Do you see companies bringing that up when you talk to them? How can we bring in AI on the prospecting side of things to reach out and communicate? And what is your experience with that?
Yeah, I mean, that's one of the areas that's changing quite a bit. So we were a pioneer in outreach in the past, and we had something called the Funnelator that was a combination of CRM and a marketing automation system and sourcing leads and qualifying them and so forth and following up with SDRs. And we generated 40% response rates years ago. And
Wow.
our customers were falling over each other to try and get this, right? Because standard direct marketing response rate was 2%.
Yeah.
But you won't be surprised to know that as the years have gone by and the white noise has increased year after year after year, that that response rate now has dropped down to into the direct marketing realm. And I think maybe even lower because people are just desensitized to email outreach now. You
Yeah.
spend part of your morning just trying to get rid of all the stuff in your mailbox. It blows me away the number of solicitations that we get from lead generation companies that are nothing more than the spray and pray approach. And most of them all claim to have to be AI driven, but when you really get down under the covers, the extent of the AI usage is, it's kind of content development, or
Yeah.
maybe if they're on the leading edge, they're using it to sort through and ICP against a Zoom info list of targets, and that's about as good as it gets today. So there's going to need to be some companies are going to have to step up and really leverage AI in a way that it can be effective in that space because as I mentioned right at the beginning of this, the early stage of the sales cycle is the critical part now. That's the hardest part of the sales cycle. And lead generation is, successful lead generation is critical to making that all happen.